Hello, sir. Hello, friends. Now, welcome to the sixth lecture series of Unit 5 Credit Rating. In our previous lecture series, we started discussing the second part of the Unit 5, that is, after credit rating, we were discussing the venture capital. In our previous lectures, we have already seen the venture capital features of meaning of venture capital, definition of venture capital, features of venture capital, advantages and disadvantages of venture capital. Now, by this time, the concept of venture capital is already clear with you. The venture capital is a new business initiative which is financed by the financial institution called a venture capitalist. So the new venture is an idea generated by an entrepreneur or a scientist who is not having the financial support of his own. Therefore, he tries to depend on venture capital investors. So venture capital investors, when they like the project or idea of the particular entrepreneur, they will invest money. But this venture capital is not for a short period of time, it is for a long period of time, and it is risky because the idea which is generated by an entrepreneur is a new one. So the success totally depends on the performance and activity of an organization. So venture capitalists not only invest capital but also gets involved in managing the business and gives the directions and mentor in that particular project and makes it more successful business opportunity. When it gets more market share, when the business becomes more, when the, when the organization becomes more growth oriented, then venture capitalists will withdraw the money or sell out it to somebody else at a higher rate of returns. So normally venture capitalists invest money in equity shares or in debentures which are participative, where there is a more chance of getting involved in controlling the business or participating in the management activity. Now, in this lecture series, we will discuss about the methods of the further aspects of the venture capital, that is, methods of funding of venture capital and venture capital funding process. So, the venture capitalist does not invest money at a single time, he will invest at a very different stages. So, there are various stages of the venture capital funding process. We will discuss those things in this lecture series. Now, let us come to understand the methods of financing a venture capital, how the venture capital or the new business proposal is capitalized or investment is made by the venture capitalist industry institute or a person. So there are around four different methods by which the venture capitalist will invest the money in the business. One is in the form of equity share. Equity share, as all of you know, that it is a share, it is having a more risk because it is the investors in this equity share are called as owners, because it is a owner's capital. Equity is an owner's capital because equity share does not guarantee the specific return on the investments. If there is a profit, the return will be given to the equity shareholders as a dividend. Or if there is no profit, then the equity shareholders have to sacrifice their profit and they keep mum. So whenever the profit is earned by an industry or in a company, the first preference is given to the bank loans or outside loans which are secured. Next is given to the debenture holders. Next preference is given to the preference shareholders. If anything is left, all that money dividend will be distributed among the equity shareholders. So if there is a abnormal profit, all the equity shareholders may get the abnormal returns also, because the return is not fixed. So the investment is more risky. So venture capitalists uh, invest money in any business in the form of equity. Next one is participating debentures. Participating, as you know, the debentures are the fixed return yielding yielding instruments. It is a debt instrument issued by a company for raising the capital from the public. So, in case of participating debentures, no fixed rate of dividend is mentioned. No fixed rate of interest is mentioned, but they are dividends. They receive the interest. Debenture holders will receive the interest, not the dividend. Equity shareholders and preferential shareholders will receive the dividend. Dividend is the portion of the profit, and debentures are issued given the return in the form of interest. Whether the company makes a profit or loss, it is not concerned with the debentures. Debentures holders will receive the fixed rate of interest. But in this case of participating debentures, there is no fixed rate is mentioned. These are the debentures, but if there is a no profit, then the rights of recovery collecting the profit will be switched on to the next year when the profit is made. Whenever there is a profit made, the participating debenture holders are given the returns more than the ordinary debentures or fixed debentures, because the debenture holders will get the bonus if the company makes an abnormal profit. So venture capitalists prefer to invest either in the form of equity or in the form of participating debentures. Even participating debentures are also having a voting rights like equity shares, and the investors in the participating debentures can participate in the management of an organization. They become the part of the management board of directors or management wing. Then next one is conditional loan. The third important way of financing a venture capital is conditional loan. What is a conditional loan? A specific condition is levied while giving the investment to the venture capitalist while investing the money in the venture capital by the venture capital owners. So this conditional loan includes specific conditions, criteria to which the loan is given, and if the company makes abnormal profits, then the loan cannot be returned, but the more interest can be given on the road loan. So there are various conditions levied on this loan. Anyhow, through this also, venture capitalist wants to control the business of the uh, mm, venture capital, management of the ventures, new industries. So the income note is a one more way of investing money. Venture capitalists expect royalty on commercial use of the product. So in this case, income note in the sense, if at all any company where the venture capitalist has invested money becomes any abnormal profits or grows very nicely, then the royalty is charged on the commercial use of the product. If the commercial product is commercial used, they expect the royalty. Royalty is a kind of what you call as intellectual property rights for using the assets of venture capital by any other organization. Royalty is expected to be given to the investors of the venture capitalist or venture capital owners are receiving the specific returns called income note. Called income note. So income note is nothing but a kind of a royalty on the commercial use of the product, because the owner of the business, the rights of ownership lies with the venture capitalists rather than the entrepreneurs who establish the business. Entrepreneurs will work like a what you call as a intrapreneur or a kind like a worker in the organization, and venture capitalists become the owners of the organization. So they expect that if at all any asset is used, any product is used by any for commercial use, they charge certain kinds of what you call as royalty on using that particular product, being the owner of the organization, and receive that income. It is called as income note. So these are the various ways through which the investment is made in the form of venture capital in the venture capital's opportunities. Now the next one is venture capital funding process. The venture capital funding process will be made in four different ways. Funding process involves four stages. The first one is idea generation. When an idea is generated for experimenting any kinds of ideas or for developing that particular product in the form of a business product, so a lot of laboratorial experiments are conducted, expenditure is involved by the entrepreneurs or the inventors. So for carrying out the projects of this kind of innovation and developing a product or identifying the new products, for all that laboratory expenditures and everything is involved. In this case, in case of idea generation, as kind of seed money is given to the scientist or the entrepreneurs by the venture capitalist. So they give this seed money for developing the lab facilities, for experimenting the things and finding out the results and all that. All that cost is considered as the seed money. Once the product is identified, product is produced, when the what do you call as the product is generated, so then it will be commercialized in future. So in such cases, this after the idea is generated and when the product is identified, if at all the product has to be produced, then startup investment is made by the funding is given by the venture capitalist. Startup refers to for starting the mass production of that particular product and making it more available, convenient to the customers in the market. So where the rigorous production activity is carried out during this startup level. Ramp up refers to the stage where the maximum production is made and the gain is taken out, and once the product becomes more that is famous in the market, and when the goodwill of the company is established, now in this case the venture capitalist will return all the liquidate all the capital by selling the shares at a premium rate or at a higher rates in the market, and liquidate their investments. After liquidating, they exit from that particular business, so they do not keep a relationship after exit. Exit is the stage where the venture capitalists will withdraw all their shares from the company, sell the securities to somebody else and liquidate that particular thing. This stage is called as exit stage. After exit stage, there is no relationship by the venture capitalist with the business of an entrepreneur, because both got separated, and the venture capitalist will give all the rights to the where that is entrepreneurs or who generate a business idea, and they become the owners of the organization, and venture capitalists will lose the ownership and get back from the industry. So these are the four different stages at which the funding is made. During the exit time, the venture capitalist will liquidate all their investments and come back. So there are certain steps in venture capital funding process. The first step is idea generation and submission of the business plan. The initial step in approaching a venture capital is to submit a business plan. In this idea generation, when the idea comes to an entrepreneur or a scientist, he will put it in the form of project report. So the project report involves the total amount of investment, the production systems to be made, raw material required, budget relating to the investments, and capital required for the business, and how the capital is collected from the venture capitalist, whether it is by issuing the equity shares or issuing the debentures. All these things are taken into care, and it is put forward in the form of a written report called a business plan. So this business plan will give an idea to the venture capitalist. Venture capitalist will should go through that and understand this what you call as project report, and if they are liking with it, they will fund it. Second one is there should be an executive summary of the business proposal in case of submitting the what you call as the budget, or submitting the uh, business plan. The one of the parts of the business plan is a summary of the executive summary of the business proposal. In this executive summary, the brief note about whole structure of the manufacturing activity and selling activity and profitability is mentioned in a synchronized or chronological order. So that is called summary of the business, executive summary of the business proposal. Anybody reads the executive summary will come to know the gist of the proposal, but the detailed discussion of the proposal is made separately in the business plan, in a business plan. So the third step is description of the opportunity and the market potential and the size. There, in that particular proposal, description relating to the marketing potentiality, the what you call as opportunities of the market, and all that will be written here. Review on the existing and expected competitive scenario. Detailed financial projections are made in the project report. So review on the existing and expected competitive scenario. So it is about the futuristic plan is mentioned in the business proposal, and detailed financial projections are also included here. In this case, right from raw material till the finished goods is made, all that expenditures are listed, and the expected income is also calculated, and based on that the financial projections shall be made, how much working capital is required, how much long term capital is required. Based on the projections, the liquid investors will be asked to invest the money. Then details about the management of the company, who are the people involved in the management, how is the entrepreneur, how is his experience, quality, all these things are mentioned in this business plan in this model. There is a detailed analysis done on the submitted plan by the venture capitalist to decide whether to take up the project or not. So after presentation of all these because business proposal to the venture capitalist will read it, understand all the concepts, and decides whether to invest or not. This is called then there is a detailed analysis done of the submitted by the plan by the venture capitalist to decide whether to take up the project or not. So these are the points in the first stages. In stage number two, introductory meeting. When the business proposal is accepted by the by the venture capitalist, he will call the entrepreneurs for discussion on terms and conditions. Uh, Preliminary studies, venture capital find the project as their performance. There is a one-to-one meeting that is called for discussing the project in detail. After the meeting, the venture capitalist finally decides whether or not to move forward to the due diligence stage of the process. So after the project report is understood, the personal meeting is called by the venture capitalist with the entrepreneurs, and a lot of discussions will happen between the two in understanding the business fundamentals and also understanding the nature of both the organizations and all that. So the personal discussion will materialize. If it materializes positively, then it goes to the next stage called due diligence. What is the due diligence? Due diligence phase varies depending upon the nature of the business proposal. The process involves solving of queries related to customer reference, product and business strategy, evaluations, management, reviews. In this due diligence, the venture capitalist will try to understand all the phases of the business depending on the nature of the business proposal. The process involves solving of queries. If there are any queries with the venture capitalist, these queries will be solved by the entrepreneurs who comes with a business idea, or they will understand the difficulties connected to that and bring the solutions connected to that. So this stage is called as due diligence. Once the due diligence also clears out, the venture capitalist funding process comes under term sheets and fundings. If the due diligence phase is satisfactory, the venture capitalist offers a term sheet, which is a non-binding document explaining the basic terms and conditions of the investment agreement. So it comes with the agreement stage. In this fourth stage, agreement will be made between the venture capitalist and the entrepreneur if they find the business proposal is good. So the term sheet and funding due to these features, venture capital, which is non-binding document that we have already seen. Term sheet means it is an agreement made between the parties, and the legal document is created binding between the parties. So these are the various steps, stages involved in venture capital funding process. So in the examination, most of the time this question will be asked. So now kindly prepare for the exams well, and we will discuss the remaining aspects in the next class. So I thank each and every student for listening this lecture, and creating interest among yourself in attending the classes. Thank you. Thank you one and all.